Hello again, everyone. Welcome back to the Daily Gold podcast. Today is Saturday, June 1st, 2024. Hope you all had a great month of May. And here with me to wrap up the month of May, as he always is, Vince Lancy. He is an adjunct professor at UConn. He is with Echo Bay Futures and also writes the Gold Fix on Substack. You can also find him on Twitter. Vince, I know you and I are a little tight on time today, but we're going to rock and roll here pretty quickly. So first thing, let's get right into it. First thing we want to do is wrap up this month, but also follow up on something you discussed in our recap last month with respect to maybe the economy is getting a lot closer to a turning point with respect to, is it going to go the way of recession or stagflation or soft landing?
Right. Okay. So how do you want, let's, this month versus last month. I mean, what do we have? We have this is like your stuff, right? This is like what do we have? A new all-time high monthly close, right?
In gold and silver. Well, not all-time high in silver, but in gold. We had another new all-time
May
high.
as well be.
Not the greatest of candles in the last 2 months for gold when we're looking at the monthly charts. But hey, it closed higher last month, closed higher this month, but was unable to hold all those gains. So yes, I think the market is in correction mode with respect to gold. Silver, I think the same, but you wouldn't know it looking at the monthly chart because that's a pretty strong monthly candle, much stronger than gold. Silver's highest monthly close, I just looked this up, since January 2013. So almost getting closer to a 12-year monthly high. That's what happened on the month.
Right. So a quick comment about, an observation about what you're saying there. It's a truthful statement. It's a fact to say, I'm talking about like people that are listening, that are hearing other people talk about this. It's a truthful statement. It's a fact to say highest monthly close for gold of all time. That's truthful. It's also truthful to say that it's off the highs. But for me, the arbitration or the arbitrator between those two, I'm bullish macro, but I'm less bullish short term, is the macro discretionary guys. These are the guys that come in that, buy at the end of a month, the beginning of a month when there's a new high, when it's off the chart, when it's a new high, call me. And people who never traded before, trade it. And I think after we've had so many months in a row of new high, I'm putting myself in a macro discretionary guy's shoes. I bought it on the first monthly new high, and now we've had new monthly highs for like 6 months. Some of these guys are thinking weak close, possible retracement month, and there's going to be some selling. Now, I don't know how much selling there will be, but I think the big boys are definitely buying dips, but they're also selling rallies now. Okay? The CTAs, the smaller guys, they're not buying anymore. They're selling. So we are dependent on the flows. We're dependent for the CTAs to sell and the macro discretionary to say, I want to buy this, I want to buy the dip, or maybe some other country, who knows? But I think what did we talk about? Are we supposed to talk about the 60-40 portfolio? Or are we supposed to talk about what I said last time?
Well, I think we could get into that after we talk about the economic. Because you were thinking in May we might have some economic data that'll maybe push us a little more towards, again, recession or stagflation.
That's right. That's right. And that's right. I remember saying we're probably going to have the data, the data inflection point, and it's never black and white with data, especially when it's cooked. We're going to have the data inflection point that will either push us into the soft landing, recession, or stagflationary environment. Now, we didn't get the black and white answer. However, I've noticed in my studies that major banks are starting to disagree. Not violently disagree, but for example, Citibank is saying we're in a recession, right? Citibank is saying we're headed for a recession. It's going to happen this time. And Bank of America is saying, I think it's Bank of America, I forget what it might be, is saying there's going to be no landing and we're going to be fine. It might be them. You can't quote me on that one. But what you're seeing is as we approach the soft landing peak, like this is peak soft landing conversation, some banks are going to say, soft landing, we're going to have a recession. And then some people are going to say, we're not going to land at all. And I think some of the bigger banks are starting to flip because the Fed's not going to ease. At earliest, they'll ease in September. And look, the bottom line is people who are smarter than me and sometimes me knew that they weren't going to ease, not 6 times. Banks they make ridiculous statements. They get people to buy stocks. And you can't reverse all of a sudden and admit that you're that wrong. You start to step back and retrace a little bit. Well, not 6 times, 5 times, not 5 times, not 4 times. Anyway, some of the banks who did not say 6 times they're going to ease are already saying, and I'm quoting Citibank right now. I have it on my screen right now. The cycle, this is as of May 31st, right? This is yesterday. Citibank says the cycle is turning. Citi's take. The U.S. economy is clearly slowing down. And in our base case, it is headed for an outright contraction. This came out after PCE came out, okay? So this is a completely updated, cutting-edge opinion, and it's not crap. All right, so to keep reading. Consumer spending declined 0.1% month over month in April after Q1 data were revised down to show a more dramatic decline in real goods spending. People aren't buying stuff anymore. Core PCE slowed to 0.249 month over month, still elevated, but enough of a slowdown to keep Fed officials on track to cut later this year, even if hiring holds up better than expected. Job hiring holds up better than we expect. We continue to expect a first 25 rate cut in July and 200 basis points of total rate cuts over the subsequent 8 meetings. So Citibank, who never came out and said 6 rate cuts, they may have said 3 or 4, I don't know, but we believe that there will definitely be a rate cut of 25 basis points in July because all the economic data has turned, right? And the inflation data is now catching up. So they believe rate cuts are coming. Now, if you look at Goldman, for example, Goldman had been more aggressive on the cuts, and now they're saying, we think there could be a cut in September. We're not so sure about June or July. So the banks are starting to really diverge, meaning Citibank says, we're going to ease because we think there's a slowdown coming, a recession coming. Whereas Goldman and maybe many of the other banks are saying, we might not have a landing at all, or we're not going to have a landing at least before the election. So anyway,
I have a quick follow up on that. Whenever
sure.
After you finish your point.
Well, I mean, the point is we didn't have a line of demarcation saying it is or it isn't, but we are seeing the banks start to disagree amongst themselves now, which says to you that a divergence in predictions on rates says that we could be in the soft landing, or we could be veering off one direction or the other very soon. What's your follow-up?
My follow-up is, do these banks, like when the economy is approaching or at a turning point, do they tend to disagree, like going into that point? Like, or is that kind of random, or like when it feels like a turning point might be coming, they all kind of disagree, as you're saying?
Well, there's a pattern, and the pattern has been in the QE era. The pattern is the banks agree on turning points. Okay? They don't agree on timing, but they agree on turning points. So I'll give you an example. When the Fed was easing or biased to ease, they all agreed on the Fed's either going to ease in June or August. But they didn't say 6 eases. They just said an easing cycle is going to start. I think this hike cycle really, really threw some people off, because the way that we've seen this historically is the Fed eases, the Fed starts, and everyone agrees, the Fed starts to hike, something breaks, the Fed eases again. So they will disagree on when the Fed is going to stop hiking. Like Goldman will be the type of bank that'll say, we think something's going to break. And sure enough, many times something breaks.
Yeah.
But this
Well,
time,
because they got the info from the Fed and the Treasury. That's how they know.
probably. I mean, probably. I mean, that, all right. But this time, everyone said something was going to break, and things did break, like SVB. But the Fed didn't ease anyway. The Fed just didn't ease. So I guess to answer your question is, in the hiking cycle, we see more divergence. It seems like the city banks are more conservative, and the Goldman Sachs are more aggressive. So some of the banks have adjusted to the new environment, and some of the banks have not. But
And
we'll
so
see.
who's saying no landing? Is that Bank of America, you said?
No, I mean, you can't quote me on that. I shouldn't have said that. I'm
Okay.
not really sure. No. Bank of America's chief strategist, Michael Hartnett, said, looking at the statistics, he wasn't predicting. He said the market is discounting very heavily a soft landing. And so for him, he looks at it like the surprise, if everyone's betting on soft landing, the asymmetric bet, the crowded trade, is if we have no landing, which is why you want to be long stocks or commodities, actually, or if we have a crash landing, in which case the Fed has to ease. So for him, it was like everyone's betting soft landing. I think either no landing and the Fed can't tighten because of other data that he had, or crash and the Fed has to ease. And that's why he's been bullish on commodities for the last 6 months. I hope that helps a little bit.
No, it does. And I mean that was the right call in the last year or two when after we came out of 2022.
Yeah, you're right. I mean, it was. I mean, so I mean, I guess we're at it. We're coming out. It's like we're coming out the other side, and the other side is going to be either they're going to you come down on one side on this. Either you say, and we're getting into minutia now, right? So that means
Yeah.
like we're getting near the deadline, right? So it's like either you're a bank who says the Fed's going to ease either in September or later, which most of them are saying now, or your Citibank saying, nope, the data says to us that they're going to ease in July. So the people that I think, some of the banks that are saying they'll ease later, they're probably looking at the market as saying the Fed might want to ease, but they're not going to because of the politics. And Citibank is saying maybe the Fed wants to ease because of the politics. I don't know, but the politics should not factor into your math, and I
But
don't think they
yeah,
factor into it.
it seems, I mean, I don't want to jump jump to conclusions here, but it seems like the consensus though is that the Fed is like they're headed for easing at some point.
Yeah. But people have been saying that for a year, right? I mean, nothing's broken.
Right.
I mean, things are broken, right? SVB, Switzerland, like we didn't ease. He didn't ease. And it begs the question, does easing really matter anymore? And of course it does matter. But if he can go in there with a sniper rifle and fix the banks with BTFP and these special facilities, then monetary policy isn't as important as it used to be, at least um, in a crisis, provided it's industry specific. You follow?
Yeah, no, I agree with that because we're in a new age of fiscal stimulus. And so that's
Right,
been a far bigger driver than monetary policy.
right.
But so it basically sounds like we're still not, we didn't, with respect to coming to that inflection point on the economy, like we didn't get an
Right.
answer on that in May.
We didn't. I mean, we moved the needle towards recession. We moved the needle towards how's this? We moved the needle towards the Fed's not going to ease until we have a recession, right? So more and more people are thinking the Fed's not going to ease and or a recession is coming, but nobody's committed to it except, in my opinion, Citibank. So really, it hasn't moved that much, and I think everyone's really just kind of flipping coins because of the election now, except for Citi seems to be of a different mindset right now. So yeah.
Right. And so, and we also talked about this last time, my gold against the 60/40 chart. And so, wrapping up last month. So I think it was down a little bit. Interestingly, silver against the 60/40 had a big gain, but I mean, that's a different
Yeah,
thing.
but that's
But so,
I like
yeah,
that. I like that,
but,
but
but, but yeah, gold against the 60/40. Um, but yeah, there was no real, like we said, there was no real movement on uh, the trajectory of the economy, at least as far as the inflection point. And so therefore gold against the 60/40, we didn't have any real movement on that. Like I said, I
no,
think it was
right, right,
down a
right. I
little
mean,
bit. But I know
I
Hartnett, I don't know if you want to get into this now. I know
oh
your
no, we're
guy
going to get into
Hartnett
it.
from Bank of America. I know that he was talking about this, or at least gold against the stock
No, no, he
market.
wasn't. He wasn't talking about this. Yours is better. Sorry, Michael. But all right. So several months ago, you introduced me to the 60/40 versus gold, and no one else is doing that. To be clear, okay. And I immediately said, "Oh yeah, this is actually very relevant and very realistic." And the reason I said that is because uh, people like to compare gold to the S&P or gold to the Dow, and those are great comparisons, for yardsticks. But when you look at what's happening in the world now, people are substituting gold for treasuries. So it starts in Russia. They had to by necessity, right? It's moving to China. They're selling treasuries or buying gold. Last month, India bought a shit ton of gold on top of the shit ton of silver they keep buying. And so you have to ask yourself, I mean, without going down the rabbit hole, it's actually very simple. If you're uncomfortable holding treasuries, you need to hold the only other tier one asset in the world. And the only other tier one asset in the world is gold. So when you take that fact back and look at the world is now looking at gold versus bonds, not stocks versus bonds, your 60/40 portfolio is very relevant. It's so relevant that when I looked at, I do an analysis of Hartnett's reports, and 2 weeks ago, to the point that you made, Hartnett put a chart in there, like unprecedented for him. He put a chart in there comparing the S&P 500 to gold, and he had it wasn't log normal like yours was, and we'll pop it up there. But I put a little combination chart together for you. Hartnett draws a red line through the middle of the last 5 years and basically says net gold and the S&P 500 are flat with some chop for the last 5 years. On the other hand, your chart, which I've been watching ever since we talked about it, it also is a chop, but your chart is log normal, which is neither here nor there, but it's log normal, and you draw a red line at the top saying this is going to be kind of bizarre, saying we haven't even begun to break out until that line is broken. And so your 60/40 chart, which hopefully you'll be able to pull that up with everyone.
Yeah, we'll have it up
when they're looking at your 60/40 chart, says, when that line breaks, you're looking at gold replacing bonds. You would say gold replacing stocks eventually. And I would say, yeah, but bonds are the problem right now. And you can see that our bond market's going to zero. So anyway, I guess what I'm saying is maybe Michael Hartnett saw your chart. I mean, he didn't do a 60/40 portfolio, but he certainly did he heard our conversation. He didn't do a 60/40 portfolio.
He listens to this podcast, our monthly wrap ups. Yeah,
absolutely. He definitely listens to the podcast. Exactly. It's where he gets all his information.
Isn't it just a side comment? Isn't it funny? I mean, there's all these YouTube podcasts, and I mean, I'm not saying we're not serious, but it's like, oh well, there's a good amount of listeners. But then, occasionally you get like an email or you get contacted for some guy over the years, and it's like, wow, like that guy actually listens to that famous guy listens to the pod. Like there are actually famous people, probably people even in Treasury and in the government, that I'm not saying they're binge listening to these YouTube podcasts, but they've probably listened to a few of these podcasts on YouTube at some
Oh
point.
yeah, I think look, I think when you're at the level that a Michael Hartnett is or a Zoltan Pozar is, where you're at one of those high levels, you don't have time to listen to those. But someone on your desk says, "Dude," one a junior trader on your desk
Yeah,
says,
yeah.
"Dude, I just saw this video and it's better than our shit. You got to look at this." And the guy will look at it. Now, I don't know if that Hartnett has ever saw my stuff, but I know that at least one of the traders on his desk does, because I've seen it reflected in some of the work, and I can say uh, comfortably that, well, I've had email correspondence with a certain Hungarian uh, economist in the past. Nothing deep, but enough to know that we know each other exist. He knows I know he exists. Anyway, so let me just say, I think what's happened over the last, say, 5 years is that there is such a lack of decent, not even good, decent content coming from anyone outside of an internal bank desk, that you're getting reputable people coming to you. Like, I'll give an example. I don't mind saying this. One of the first, he may not even read my work, but one of the first people that I noticed in like an email list that I got, um, it is a former senator who is a rabid libertarian, okay, who definitely read me on Zero Hedge. That's all I'm going to say. So
If
there
you
aren't too
said
many
if you
of those.
said congressman, we could have guessed that, but you said if you said and maybe the congressman I'm thinking of it does read your stuff, but you said senator, so that's
Well, unless I'm lying and it was a congressman.
that's a more difficult guess.
Unless I'm lying and it was a congressman and I just don't want to say senator, I don't want to
Oh,
give it away.
yeah,
Okay, let's just
right.
say,
I get it. Yeah.
you know, someone in government from a state, not he's not federal. So yeah, I think to your point, uh, it's by virtue of the lack, like precious metals specifically, and the media in general have left such a gaping hole for people who want to learn something. And people like you and me and Chris Marcus and Tom Bodrovics, we're all filling it, with genuine content. And as long as you can get over the fact that our production isn't CGI with big-breasted women yet announcing the news for us, you're going to get something really good out of it. However, I might be looking to hire someone who looks better
Yeah.
than me for broadcasting.
Shout out to the Bullion Boobs Twitter account.
That's right. Shout out to Bullion and Boobs. Yeah, we're going to do something.
But yeah, okay. Anyway, circling back to a more serious level. So yeah,
Why, that wasn't serious?
no, well, I just meant as far as the 60-40 and that kind of analysis.
Yeah.
Yeah, but to what you were saying before, like I'll just add my own editorial comment. Um, I completely agree because if looking at that chart and if we see the ratio, surge above that red line resistance, um, you get some weakening in the stock market and some money starts moving from stocks into gold. Not a lot, but it's just you just get the turn and some of that money starts moving into gold. Gold could start to go vertical, and I'm not saying that as like a gold bug, like gold's going to go to 20,000 or
No, I mean, look,
10,000,
they're running
but
out of
just
choices.
yes, exactly, because we're seeing slowly but surely, and this has happened in the last couple of years. Central banks are buying people in China, people in India, Russia, foreign governments because of all the sanctions. And the bond market, that's cracked, so that money's moving into gold, as you said. The stock market is the last thing. I mean, that's
Right.
the last thing that's holding gold back from really exploding. I mean,
Right. And
when that goes, and you don't even need to have like a 50% bear market. Like if you just have a 15 or 20% decline in the stock market at this point, I mean, look out for gold. It's going
Jordan,
to
you're talking about
shoot
stagflation.
higher.
We want stagflation for gold, right? The long, drawn out 15% drop that makes people go like this. I'm going to put my money, take my money out of stocks and put it into bonds. Oh shit, bonds suck too. I'll put it into gold, and that's it. If we get a crash, gold's going to go up too, but gold will drop as well. But yeah, you're right. I mean, there's you can't rotate from gold from stocks into bonds anymore. In fact, if you look at the flows for the year, I just saw Hartnett's most recent report. On the year, money has flowed into bonds. Net money has flowed into bonds, not government bonds. People are taking their money out of government bonds and taking risk on AAA corporates now. So there's like a little bit of a trickle down yield chasing. So what happens when they panic? They're going to sell stocks. They're going to sell corporate bonds, buy government bonds, and say, "Wait a minute, how much money am I going to put into government bonds? Well, let's put 10% of that in the gold." And that's how it's going to go down. And we're going to start rocketing.
Yeah. Okay. Yeah, getting into the next thing. Uh, let's talk about what's going on in India with Indian gold demand, because I mean you follow everything, and I mean that you follow every single thing that's going on with this market, and I know that there's something that came across your desk that really caught your eye. So I want to get your take and your analysis on why
I
this is
mean,
important.
we'll touch on silver if you want to as well, because silver is where all the Indian conversation is about. But last week there was a headline, and the headline was India repatriate. They don't use the word repatriate because that's too prideful. India got back like 100 million. A lakh is 100 million. 100 tons or whatever it is of their gold back, and it was a significant amount. And you know, without going down the Indian hole, the Indian rabbit hole, just to say that it's significant for them to say that publicly because it's been a message of demoralization that they had to have their gold somewhere else. It's national pride to get it back. But anyway, that's the main point in the headline. So I'm kind of breaking with you the information that I just saw today, and that is, I'm going to read a quote from a report that I have in front of me. Indian gold demand. Central bank RBI has been active buying gold. According to the World Gold Council, RBI gold purchases in the first quarter of 2024 has been 19 tons with an ES, metric tons, surpassing the full year of 2023's total of 16 tons. So in one quarter, they bought more than they bought all last year, right? It added another 5.5 tons in April. It now comprises 8.5% of India's total reserves. That's high, okay? And I mean, I'll get into the analysis another time, but what I'm saying is that who's not buying now, Jordan? China's not buying now. They're taking turns, not getting in each other's way. China had been buying. They backed off a couple months ago. Now India's been buying for this quarter. They're respecting each other's space and taking turns buying. Anyway, this is all related to the BRICS coming out on a currency, but that's a whole other conversation that we can have some other time. But that's it. Gold, like the bottom line on this part of the conversation is India bought more gold in the first quarter of 2024 than it bought in the full year of 2023. That's crazy, and this is beyond the wedding stuff. Like there was additional strong wedding related gold buying several months ahead of the usual busy wedding season. So maybe the wedding season isn't discounted yet. Gold buying coins were noticeably stronger among younger age groups in India. I'm telling you, look, the gold bugs are 50 to 70 in the US. They're 20 to 40 in Asia, or 15 to 35. Gold is where it's at, man. I mean, silver too, but gold is where it's at. Metals are where it's at.
Right. Well,
That's it.
yeah, I have one or two quick follow-ups, before we get into silver. That was a good segue there, but I do have to follow up. So and I have a habit of lumping two or three questions together, but I'm going to try and do this for the sake of brevity. So India's buying and China's they're taking turns. I mean, is it India and China are taking turns, or do you lump them in together with the
Oh,
BRICS?
okay. Well, it's not even what I just said to you is not even the level of conjecture. It's speculation, but it's what you do when you're cooperating. The big players. This is what I noticed. The pattern I noticed was when China was buying gold last year, India was buying silver. India didn't buy gold when China was buying gold. India didn't buy gold. I'm sorry, China didn't buy gold when Russia was selling. Okay, they bought from Russia. China wasn't in the market buying gold, and so to give you a grouping, I think it's kind of like this: China's the big boy. When China's playing, all the smaller countries don't front run. India's number two, and not that Russia's small. India's number two, and they will wait for China to be done. Russia doesn't have to go into the market buying as much because they're massive producers, as is China. But Russia doesn't have the economy that China does. So to answer your question, it's probably like China says we're going to buy, like the alpha dog, and everyone says, okay, we'll wait. When China says, okay, we're going to take a break, then the other guys take their turn. That's my opinion. And it makes sense if you're working in a cooperative environment.
Okay, last follow up on that. How do we know that buying is going to continue? Because the Indian, and I'm being a bit of a skeptic here. So the Indian demand is great, but that was first quarter. Yeah, but that makes sense because look at where the price went. I mean, we saw the breakout in March. I mean, yeah, I know that was the end of the
Right.
first quarter, but what's the indication that level of buying is going to continue the rest of this year
Right.
and not cool off per se?
No, that's the healthy skeptical question. And the answer is no one knows. You can't bank on future purchases. And you can't bank on that this is the beginning of a bigger trend. And it could be beginning of a bigger trend. But I'll tell you what I'm using to keep myself honest. You got to keep yourself honest on this stuff. I believe that these banks are buying more than they have in the past for two reasons. One, they're buying because they want to literally get out of dollars and get out of bonds and create the collateral they need for their new contract. Two, the second reason is a little bit more flashy. If you look at Chinese purchases over the last 20 years, they rarely talk about their purchase until after they're done. It's over. A year goes by and the gold goes like this, up in 1 month, right? But in the last 12 months, China has been announcing it every month. So they're being transparent with their purchases. They're letting people know. They're conveying to other BRICS members that they're doing it continuously. Now, India is doing it as well. So my conclusion is, looking at India only, while I cannot expect that India will buy that much over and above on a trend for the rest of our lives, I can bet that the buying will continue in a more aggressive as opposed to a less aggressive fashion between now and the BRICS summit in October. So my belief is that China's done buying, they've done it publicly, and now all the other banks are going to buy, and India is showing off. I mean, India's showing off, right? It's like we got our gold back and we're buying more and we're telling the world about it. India is coming out of its shell now. Now, the other countries, I mean, Kazakhstan turned buyer, like who cares, right? I mean, you should care, but that's the point. All these other countries are going to come out as well. So will it continue for the next year, 2 years? I have no idea. Will it continue for the next 6 months? I believe strongly, yes. I really do.
Yeah, and I mean that helps set a higher and higher floor in the market.
Right, exactly. And we saw that. It sets a higher floor. Look, if you've got a central bank bidding whatever price, and you're a bullion bank and you're short doing your business, you can't wait for the market to drop $50. You got to buy it. You got to cover because you need to provide a service, and that is liquidity.
Right. Okay, one more thing, Vince. Um, Tell me what's going on with silver. I know I can look at the price. We had this big move. I see a lot of, scuttlebutt on social
Yeah.
media, China, India. The price in Shanghai is now $39 an ounce. Just give me your take on what's driving this move in silver and, what really matters.
Well, it's a convergence of things. The first thing I'll say is that for a retail investor, for an American retail investor, you can get silver. We're not running out of silver. They're not going to do that because that's how you start panic. They'll make sure the little guys are taken care of. Now, to get that out of the way, the factors that are contributing to the driving is this. And I'll start with China. About 6 months ago, well, China has been buying silver for the last 2 years, and I documented that with the help of Zhao Xiaojun on the silver demand, and they're buying it for solar, and they're buying it for investment, and they're buying it for all these other reasons. But the Chinese government, told their people, literally told their people in their own, domestic, motivational propaganda, however you want to look at it, said, you know what? We like gold. We think you should buy some silver now. And the kids are buying silver now out there. That's one of the reasons you have this premium. The second reason is there is a shortage of collateral available. Now, what does that mean? Let's pretend that there's plenty of silver in the world. Now, there isn't, but let's pretend that there is. It's not where it's supposed to be, though. So if you're a hedge fund in New York, short 500 contracts of silver, you're betting that you can buy it back because there's always going to be hedging. There's always going to be hedging. There's always going to be someone selling. Well, those hedgers aren't selling anymore. They're keeping their production. Mexico is selling silver directly to China. So you're not seeing that selling hit the market. And as a result of that, you have a shortage of collateral. And because you don't have the collateral, the physical collateral hitting the market, people can't cover their shorts. So leveraged shorts, just like in stocks, are getting hammered as a result of that. So let's pretend that I'm a short fund or a short speculator or even a short producer who's overhedged. That happens in silver once in a while. I'm banking on someone to sell, and there's no one to sell. Why? Because India is scooping everything up out of London that it can get, and that's affecting the U.S. Now you go back to China, and you've got the retail demand coming in and buying one at a time at a higher premium, and they're buying at that premium because they don't give a shit about dollars anymore. I'm not saying that's right, but they're not looking at the dollar correlation. They're looking at the renminbi correlation, the yuan correlation, however you want to categorize it, characterize it. So silver is being driven to the upside by those things in the biggest picture, by the demand side. Now, here's what drove silver last month. We talked about this in our last conversation, and I said we both understand that the macro discretionary guys are buying gold. And I said, I'm looking for the macro discretionary to say, hey, we're up $300 in gold. Let's buy a little silver. And they started buying silver. They started buying silver as the market started breaking higher, that 10% move. And they bought this first dip. If you remember last week, silver and gold both, they had a drubbing. Silver was down 4 or 5%, and gold was down like two back-to-back 2% days almost. And somebody caught the knife in silver, and it rallied. Now, it rallied. You can see there are all kinds of reasons. There's physical demand. There's all these little, but the reason is somebody bought the dip. Somebody bought the dip. Like a fund bought the dip. The CTAs, the smaller guys, the retail type funds, they puked. They're like, oh, I don't want this. This is silver. It's going to happen again. And someone said, we'll take it. We'll take it. And it probably was someone like an India. And it was probably someone like a macro discretionary global fund who also knows India is buying and is piggybacking them. So on the first dip, silver was bought by big players. On the second dip, which happened at the end of the week, I don't know. So put it this way, if we open weaker Sunday night, Monday morning, I wouldn't be a buyer of dips for the next couple of days. And that's just me talking. It has nothing to do with the whole fundamentals of it. Let's see what happens. So I believe that if you look at this from a silver gold relationship, the silver gold ratio, the other thing that makes me bullish on silver is something that I had a conversation with Michael Oliver last week in an interview with Tom Bodrovics. And Michael sees the breakout in the gold silver ratio as bullish for silver and gold, but more for silver. I historically look at that breakout as almost always rejected, like it's the end of the line. When silver starts to rally, the rally's over. It's kind of like the metals rally is running out of steam. But in this instance, because of India, because of China encouraging the retail, and because of that first knife dip being caught, I tend to think that this breakout is real and that these markets will move in tandem in both directions going forward. I hope. That's where I am. So silver is the real deal right now. It's not to say we're not going to have a big washout, but a 10% sell-off in silver is a dip now. It's not a broken market, okay? Show me a 20% sell-off in silver over a 2-month time frame, and I'll say, okay, that's done. But these, it's like the bend and snap in that movie. What was that movie? American Lawyer, the blonde lawyer, Reese Witherspoon's character, Legally Blonde. That's it. Right? Where the girl's like bend and snap, and she's like bend over and pick up your coin and just snap straight up. That's silver now. Silver's doing the bend and snap on like a weekly basis. So that's my 2 cents.
So I mean, I want to compare this to not now, but just later today. Silver's up 47% in less than 3 months.
Oh yeah.
So, I mean, a rest and a pullback is definitely needed.
Right. It's healthy. Right. The
So
question is now I say this as a gold bull. I say this as a gold bull. Like you and I are looking at the silver chart, just at silver, and saying, wow, a pullback is needed, a rest is needed. And I'm going, yeah, but will they let it pull back because they're not done buying gold? Right? If they're going to keep, in other words, we could have a short-term blow off top between now and this BRICS summit because they won't stop buying gold. And if they won't stop buying gold, silver won't get its rest. I mean, I'm not long silver speculatively right now. I mean, I'm long for, physical stacking. But I agree. I'm waiting for the pullback, and that's why I'm not buying it Sunday night. I'll probably buy it Wednesday night. You follow? I agree with you. Silver's overdone, right? Or maybe silver was underdone for 10 years.
I like that a lot. That's a great, yeah. No,
Well,
that's
you look at analogs. This is an analog, right? This is like the beginning of I think this is the beginning in silver of, I mean, I don't feel strongly about it. I just see an analog. The 2001 to 2011 rally started like this. The prices don't match up at all. Don't get me wrong, but it started like this. And if you were to draw an analog and it were to continue, and I think I got this idea from a conversation I had with Michael Oliver as well. We go much higher. So it's kind of goofy. But I mean, look, there's no selling. 30 was, we went to 30, Jordan, and we were supported at 30. That's crazy. That's crazy. Anyway.
Yeah. I mean, looking at the short-term technicals, I could see this closed at 30.44. I could see this come back. I mean, it could print to 28. I mean, I know that's not like a real, like, stepping out on a ledge type of call, but
no, but it's fair.
Yeah.
It's fair.
But because of what you said, I mean, that's this going from 33, almost 33 to 28. I mean, that is like more than what could be needed if because we're in this new bull market. And it's exactly what you said. Oh, silver's really overbought. Yeah, but it was, underbought and oversold for 10 plus years. It's so, I mean, we talked about this last time. It's so hard for everyone, market participants, to adapt to the new regime. Like it just comes suddenly and so quickly.
Right.
And it's so hard to adapt to.
It's what it's like we're the old guys in a nightclub, and we've seen it all before. And the new kids are coming in and they're like all excited. And we're like, well, what's the big deal? This happens all the time. Well, that's what's going on now. People like us, not necessarily us, but we have to fight these tendencies because we've seen these. Silver goes from 30, 67 or whatever the price is down to 28. And you know what happens? People like me go, it's done. And you know what? I would love to have that happen. Goes to 28, starts to go sideways. People think it's done. Funds start to get short again. And then he says, you know what? I think I want more silver. And boom, it's off to the races. One other thing I want to add. Everyone's talking about BRICS and gold. I want to talk about for a second BRICS and silver. See, the BRICS plan is to replace the U.S. Treasury as collateral with something that's worthy of replacement. And that means something that's a tier one asset, that's gold, that's agnostic, has no preference, and holds its value. It doesn't go anywhere. And that's gold. And even if gold does drop, it holds its value because they're using a mechanism to smooth out the moves in it now. So there's that. But silver is not tier one. So you say, oh, no, silver is going to be part of this because all of the BRICS have been asked in August of last year to submit their list of assets they wish to be considered for BRICS hard collateral for their money. And what's India been doing since August of last year? Buying silver hand over fist, right? Silver is going to be part of this mix. And, people don't get it. It's going to be 40% gold, probably 5% Chinese bonds, 5% of everyone's currency, and there's going to be oil or natural gas or somehow in there. Although it's not easy to do. They want to do it, but they really can't do it. And there's going to be silver because silver is the only other thing on earth that does not erode, is infinitely fungible across seasons. There's no seasonality to it. Can be reclaimed from its industrial use, although that's not easy compared to gold. Okay. And holds its value. You're going to see silver in this basket, I believe. I'm predicting that. Silver will be in this basket somehow. And that's one of the reasons that India and the other countries are buying it. That's it.
Silver has been money. Silver was money before gold, historically.
That's right. That's right. In fact, the irony of this is, I don't know if it's irony, but you like to do analogs. Here's an analog for you. When silver was money in England, or when England was the center of the world and silver was money there, China started accumulating silver. Now, they weren't trying to accumulate silver. They just were. Everybody wanted Chinese goods. It's like a Pier 1 opened out there or something. It's like, oh, let's get some rattan furniture. And back in the 1800s, people were buying Chinese goods hand over fist. It was very stylish. And all of Europe had an insatiable appetite for Chinese goods, and they were paying for it in silver. And China had all this silver from this. They weren't spending it. And Europe had all this Chinese furniture, whatever they're buying, I don't know, Chinese lanterns or something like that. And Britain said, shit, we don't have any money anymore. And that's when they went to the gold standard. So I'm wondering if this is like China saying, we're not done with silver yet. We're going to get you guys. That would be kind of funny. Anyway, so that's it. I'm looking at it like a big analog in the past. It's like China silver part 2. That's my theory. That's my story.
I like it. All right, Vince, I think we're going to leave it there for this month, unless there's any last little thing we forgot.
No, I've got nothing to say. I got nothing to say except these are good to do on a month-to-month basis. But you made a comment off the air. You said these seem like they're happening every 2 weeks. And yeah, things are happening fast because we're making money. Isn't that how it always works? And when you're losing money, it takes forever.
Yeah. Yeah. All right, Professor. For all those listening, how can they follow you on Twitter and subscribe to your Substack?
Well, starting with the Substack, you want to go to VBL, Victor Boy Larry, Goldfix, GOLDFIX, VBLGoldfix.com. or you can find I'm a contributing editor on Zero Hedge, and they treat me very well there, and I give them my better work uh, because I'm thankful for it. And my stuff is on there a lot. So you can find me on Gold Fixer. You can certainly find my stuff on Zero Hedge. On Twitter, subscribe for free and subscribe for premium, and you'll be seeing a lot of institutional insights on precious metals as well as economics, inflation, recession, and other commodities as well. So, happy to have you there. On Twitter, my Twitter account is kind of a mix. My Twitter account is Soren the K, Soren as in Nancy, The, the letter K as in, kitten. And that's a combination of market comments consistent with the Gold Fix website, as well as some off-color humor. So you're warned. Be warned.
All right, very good, Vince. Thanks so much, and I guess we'll talk again 1 month from now.
That's right. Cheers.
Thank you for tuning into the Daily Gold podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.